The S&P 500 was up 16% in 2025, and yet most investors didn't feel like it was a good year. That disconnect matters because how investors feel often drives decision making more than what actually happened. So, what's my outlook for 2026? As always, I don't know. I'm a pessimist. I actually think the market is too high, it's too expensive, but I refuse to let my emotions guide my decision making. Nothing has changed there. So, let's take a look at 5 things 2025 taught investors. Not opinions, not forecasts, just lessons the data made very clear. The markets went up, but the ride was rough. On paper, 2025 looks great. US stocks are up about 16% if purchased with USD, but only about 11-ish with the Canadian dollar. Honestly, currency has been seeing a rise in its impact on returns, and I think that's a testament to the global economic environment. Honestly, if enough people ask me about it, I'll do another video explaining it, but it's a little out of scope for this. International markets did even better, and Canada had an incredible year, over 30%, and bonds kind of did their thing and just had another solid year. But it didn't feel smooth. We had sharp pullbacks, trade fears, interest rate uncertainties, political drama, one of the longest government shutdowns in US history. Do I need to go on? There is so much. But the first lesson, good returns do not require a comfortable experience. Earning money by doing nothing is not free. The cost is uncertainty, and that uncertainty will always be there. If you're waiting to feel confident before starting to invest, it will probably be too late. Second thing to take away, the best returns came from places that people weren't really paying attention to. Most of the attention in 2025 stayed on the US market and big technology companies spending billions of dollars in AI research. While that was happening, developed international markets outperformed the US by the widest margin since the 1990s, and emerging markets did even better. Canada did exceptionally well. That is why diversification isn't about being conservative. It's about not missing returns. And broad market exposure, my preferred way of investing, is about removing the chance of being wrong. It's about minimizing the risk of a bad outcome. It's about making good decisions. It's not about trying to get the best possible return because of the risk you have to take in order to achieve that. Markets change and adjust. They always have. The problem is that they usually happen when people are least expecting it. And often, once that boat has sailed, it's too late to jump on board now. Number 3, headlines feel urgent, but markets move on. I don't know if this is a sign of more knowledge or a better connected world, but markets seem to be adjusting faster than they ever have done before. Again, tariffs, trade negotiations, legal stuff, government shutdowns, all of it. But yet the market recovered from each shock and finished the year extremely strong. That's because markets don't wait for certainty. They price expectations before headlines feel like they have been resolved. Reacting to news feels like it's responsible, like you're adjusting to new information in real time. Historically, though, it's very expensive. 4, interest rate cuts don't mean what people think they mean. The Federal Reserve cut rates 3 times in 2025. Some investors expected this to immediately boost markets. Others thought it was trouble, but neither really fully played out. And it's an important reminder that the Fed's control is limited to short-term rates, not markets. Long-term returns respond to growth, expectations, and investor behavior, not press releases, not what the Fed do. The Federal Reserve is not all powerful. When the Fed cut the rates and the market increased them for US debt, it was pretty funny. But it was a strong reminder of how markets work. They price and reprice based on the expected consequences of certain actions, not just what we're told. Number 5, the biggest risk isn't the markets, it's the behavior. April 2025 turned out to be one of the most volatile months in recent history. If you had checked your portfolio every day, it felt chaotic. If you didn't, you might not even remember it. But over long periods, the data is very, very clear. Investors who stay invested through uncertainty are rewarded in magnitudes. Doing nothing feels boring. Boring works. The cost of trying to avoid market drops often outweighs the benefit of actually even avoiding them. I am a 100% equity investor. My portfolio dropped more in April than my income from some entire years of my career. Was it scary? Absolutely. Will it happen again? Absolutely. That is what happens. That is the way the markets work. That is the price of making money while I sleep. And I know it will happen again. But the important thing is that I have a plan for what I will do when it does happen. And that is a fundamental truth of being a good, disciplined investor. We don't avoid the ups and the downs, we embrace them, but we plan for what we're going to do when the scary drops happen. If there's one theme that runs through 2025, it's this: markets reward patience, diversification, and restraint, not prediction. And you might be thinking, he says this every year. There's a reason for that. It comes back to a fundamental part of what I preach: make decisions based on the evidence. The lesson isn't to ignore the risk, it's to understand which risk actually matters and then make a plan for what you'll do when that risk materializes. The one that people are most scared of is market drops. So let me know in the comments what you'll do the next time the markets drop. Thanks for watching, and if you haven't already, check out the Plain English Finance podcast on any platform that you typically use. It's my wife and I talking about various areas of personal finance. We're actually starting to look for guests to talk about various topics with. So let me know if you or somebody that you know would be interested. And as always, if you have any questions, reach out, and I'll see you in the next one. Bye.